The $22 billion toll booth. Fox Corporation is spending $22 billion to stop being a media company and start being a landlord. By acquiring Roku for $160 per share, Lachlan Murdoch isn't just buying another streaming app. He is buying the operating system that controls the glass in 100 million households. The market immediately wiped 8% off Fox's share price because this move fundamentally breaks the company's traditional low-leverage profile. But looking past the initial sell-off, the strategy reveals a desperate pivot to control the gateway. In a world where content costs are spiraling, Fox has decided it's more profitable to own the pipe than the water flowing through it. This acquisition is a direct admission that being a broadcaster is no longer a viable, standalone business model in 2026. And the financial architecture behind this deal is even more aggressive than the price tag. The multiple mismatch and the debt trap. The math on this deal is where the skepticism starts. Fox is paying a 34% premium for Roku using a 60-40 mix of cash and stock, funded in part by a fresh $1 billion term loan from Morgan Stanley. They are effectively buying a high-multiple tech platform with the balance sheet of a low-multiple legacy broadcaster. This creates a valuation gap that traditional Fox investors didn't sign up for. While executives talk about scale, the P&L shows a company taking on significant leverage at a time when interest rates remain a headwind. They are betting that the combined viewing share of Tubi and the Roku channel will make them the third largest player in U.S. television. But that assumes Roku's hardware partners won't defect to Google or Amazon now that their neutral platform is owned by a direct content competitor. The leverage isn't just financial, it's a massive gamble on platform neutrality. The ACR data goldmine behind Tubi. The real asset here isn't the plastic streaming sticks. It is the automatic content recognition data. By owning the Roku operating system, Fox gains a God view of what viewers are watching across every HDMI port, including competitor apps like Netflix and Disney+. This creates a closed-loop advertising stack that combines Fox's live sports inventory with Roku's first-party data on 100 million households. For the last 5 years, Fox has used Tubi as a high-margin growth engine, but they were still paying a distribution tax to platform owners. Now, they are the ones collecting the tax. If this integration works, Fox can double its connected TV ad revenue by mid-2027. However, the risk of a regulatory block remains high, especially as the Department of Justice recently cleared the Paramount and Warner merger, creating a climate of intense scrutiny for media consolidation. The signal under the noise. This acquisition signals the end of the content is king era and the beginning of the gatekeeper takes all reality. By bridging the gap between live sports dominance and the Roku operating system, Fox is attempting to build a new version of the cable bundle that they control from the silicon up. The $22 billion price tag is a heavy tax to pay for past neglect of digital infrastructure, but the alternative was a slow death by affiliate fee attrition. For operators and investors, the key isn't whether Roku keeps selling hardware, but whether Fox can maintain Roku's open platform reputation while aggressively favoring its own sports and news inventory. If they squeeze partners too hard, they lose the data. If they don't, they can't justify the $25 billion equity value. Watch the regulatory filings in early 2027 for any forced divestitures of Roku's ad tech patents. That will be the signal that tells us if this deal actually survives its own ambition. Subscribe for more